we have had periods of time where outliers have been few and far between. The trend following community went from 2010 up to 2018 during a fairly difficult regime of mean reversion, where a lot of people were saying trend following's dead. But we know that that particular regime, it was a regime of what we refer to as suppressed volatility. We had central banks deliberately trying to suppress the level of volatility in the markets. Yes, the outliers were few and far between, but we suddenly see in 2020 this massive resurgence in outliers again. We find that central banks have used up a lot of their ammunition between 2000 and after the GFC up to 2019. And they're probably in a place now where they have less firepower to throw at trying to tame these markets.
Describe to us, in your words, what is systematic trend following and how do you do it?
Yes, so when we talk about diversified systematic trend following, it's a bit different to what a person might consider trend following. Most people consider trend following to be a visual representation of a chart and how they trade that visual form on a chart. But we are what we call quantitative managers, effectively. In we take less information from the visual form of the chart, but we do take a lot of information regarding the bias in the price series that exists in a chart. So what I mean by that is that when you view the long-term data of liquid markets, you find when you plot them in a histogram, and I've given an example in slide 1, when you plot them in a histogram, you find that they don't neatly fit. The market distribution of returns doesn't neatly fit within the normal distribution. So to understand that, you firstly need to understand what the normal distribution is about. And in an efficient market, when things are incredibly efficient and there is little edge to be extracted from that efficient market, the distribution of market returns will follow approximately a normal distribution. What this means is that there is no serial correlation embedded in that price data. So what we're talking about in terms of serial correlation is a price dependency or a lag dependency in a price series where a price at an earlier time will influence price at a later time. And there are two forms of serial correlation that any trader seeking to extract an edge from the market is seeking. So if, for instance, traders are presented with an exact normal distribution, they will find that there is no serial correlation in that data and there is no edge to be had. So that is a very efficient market, which is effectively the gambler's scenario where they're presented with no edge. But of course, from random trading, you can achieve wins and losses. That is perfectly achievable under a random scenario. But as far as sustainable long-term prospects, we need an edge in that market data to deliver positive expectancy over the long term. So fortunately for any trader or investor, they are actually looking for a degree of serial correlation in that data. Now, that serial correlation could either be what we refer to as negative serial correlation. That's where, if we could imagine where price reaches a high, it will therefore be followed by a low, and then a high, and then a low. What that is suggesting is that price is oscillating about an equilibrium. And in chart 1, you'll notice that when we look at the long-term data series of market data, and this can be applied to any liquid market data, as I do this as a standard test to evaluate whether I'll be trading a particular market. The first thing I do is I look at, say, a 30 to 40-year history of that liquid market data, and I ensure that that data does not approximate a normal distribution. I'm looking for where that market data basically spends most of its time outside of that normal distribution envelope. So if you see that chart 1, you'll notice that there are effectively 3 discrete zones where the market data does not fit within the normal distribution. And the normal distribution is the orange curve, a bell-shaped curve. But you'll notice at the peak of the distribution, around the mean of that distribution, there is a high level of activity over long-term market data. And that is representative of what we call negative serially correlated data. This is where price oscillates about an equilibrium. So we'll see that around our mean of the distribution of returns here, we'll see the histogram has a very high peak associated with this oscillation about equilibrium. Now, this is what convergent traders focus on. And convergent traders, a convergent trading methodology, is based on the principle that price will reach an adverse excursion away from an equilibrium and then return to that equilibrium. So it's based on the principles effectively of mean reversion. And there are a lot of different trading techniques that apply that principle. In fact, any trading technique that is deriving their information from a comprehensive backtest and assuming that that information contains pertinent informational data that will repeat in the future is adopting a convergent methodology. And the reason for that is, if we take the methods such as value investing, where people are looking for a significant discount, they're working on the principle that in buying that particular asset with a discount, it will revert to the mean. Or if price is overvalued, it will come back to a mean. So value investing is a convergent strategy. Pattern recognition is a convergent strategy. That's based on the principle that patterns that are represented in the backtest in the past will repeat in the future. And that tends to be associated with the signals generated from this oscillation about an equilibrium. So the way to understand a convergent trading philosophy is to understand the market's desire to operate about an equilibrium. So we understand markets of these complex adaptive systems. Now, they go into particular phases, what I call states of the market. There can be periods of time where markets display this convergent behavior. They display these regular repeating oscillations and patterns. We saw this from 2010 up to 2019. It was not just a feature of the market itself, it was also a feature of the central banks intervening into the market and selling the tops and buying the bottoms. So that set in place this mean reverting pattern where we got these highs followed by lows, followed by highs. There was this predictability about it. Now, these markets are in a convergent state, markets are very predictable. However, we know that markets can shift from state to state. And the way to view this is that markets don't always operate about an equilibrium. If we look at the different phases of a market, we can get these convergent phases, and we can get these noisy phases, and we can get these divergent phases.
Maybe, Richard, before we go there, because I'm very sure that our audience's heads are spinning wildly from what you have just explained to us in the past 5 minutes, but maybe as a high-level summary, I think on that slide 1, what we see there is a peakedness in the distribution around the middle. The leptokurticness of that distribution is essentially where that convergence happens. That is where you have that efficient body of the distribution where edges are very difficult to extract unless you are selling volatility or you are a mean reversion trader. But then we have tails to the left and to the right, which you can also see in that distribution, which are meaningfully developed. And I think what we should say is that what we see here in that histogram is essentially something that you and I are able to find in all sorts of markets. It is irrespective of that market being cotton, soybeans, crude oil, or equity indices, they tend to have that form one way or another. And I think we'll get to, as we move through the slides, I think what we want to say is at the end of the day, we're using robust techniques, trend following techniques, where we put on the position, long or short, using the same rules for every market with an initial risk budget, which we define by an initial stop loss. So we know how much of our capital we risk. And then we essentially try to run that trade for as long as we can into the direction of the tail. And hopefully it becomes a tail event, which is when you and I will be very happy, because usually these trades are then the outlier trades, which make our year or make our month. And we do this over and over again on many, many different markets. And by the way, here, it's not only the diversification. We'll get about that. I think that that'll be super interesting. It's not only the diversification that matters here, such as I'm trading soybeans and I'm trading crude and I'm trading cable, because they're different things. It's also about the number of markets that you trade, because the more hands you play in that game, the greater your chance of actually hitting one of these outlier trades, which make your portfolio.
We hope you enjoyed the video. At Real Vision, we help you understand the complex world of finance, business, and the global economy with in-depth analysis from real experts. Join the revolution at realvision.com.